Now, what can we learn from the Great Recession? What can we take away? This is what I really want you to clue into and understand a lot, is what lessons can we learn from the Great Recession? Well, the first lesson is just because you can qualify to borrow money does not mean that you should. Okay, just because somebody can give you something at a certain rate does not mean that you should take it, right? A lot of people, they found out that they could qualify to own a home. And so what did they do? They went and they took out loans to own a home, regardless of the interest rate, regardless of the amount that they were borrowing, regardless of their ability to repay, which was a huge issue, the ability to repay. They didn't have an ability to repay, and yet they took out the loans anyway. And so contrary to claims about the Great Recession, right, loans that were made, right, these mortgage loans weren't just made to low-income minority borrowers. By 2007, 61% of the subprime loans, subprime meaning below prime, meaning worse than prime, meaning that these people are getting higher interest rates on their loans, right? 61% of subprime loans packaged by Wall Street were to borrowers with good credit scores. Right, a comprehensive analysis of more than 2.5 trillion in subprime loans found that as housing booms peaked, right, the mortgage bonanza reached every racial and ethnic group, income level, and geographic area. But again, this is bad lending. This is lending to anyone in any place, and lending in a way that even if they had a good credit score, they didn't have the ability to repay for the amount that they had lent out. So that is a big deal, and that's what caused that housing bubble to burst. And we talked about bubbles and exactly what they were in yesterday's episode, and you can go check that out. Now, the second thing that we can learn from the Great Recession is that a house is primarily a place to live. Okay? If you saw yours as an ATM during the housing boom, you certainly weren't alone. Okay? People with good credit scores opted to refinance with subprime loans in order to take more cash out of their houses than a conventional mortgage would permit. A lot of borrowers also counted on their homes to pay for their kids' college. True, subprime mortgages carried much higher interest rates, but not right away. Many had low teaser rates, and this was a big thing too. A lot of these banks and financial institutions were giving out teaser rates to their borrowers, meaning that they would give you these lower rates for a short period of time, but then those rates would jump at some time in the future, right? So they were giving these teaser rates or required no initial payments at all, and borrowers figured they refinance again before the monthly payments skyrocketed and might even eventually sell the house at a big profit in order to pay for their retirement. This was a pipe dream. As the recession made painfully clear, you can't count on your home to be worth more than what you paid for it when you're ready to sell it. Okay, this is why we try to get our house paid off. Okay, we want our house to be paid off as a part of the financial action plan, because even your house, even something that seems so safe and so benign, it can hurt you, right? If you make bad decisions about it, if you're taking equity out of it, if you're taking out a second mortgage or refinancing or whatever, you can run into issues when it comes to your home. And easy money typically turns into a bubble, and easy money typically turns into a crash eventually, okay? So your house should be viewed as a place that you live and not some place where you can take money out. You don't need to pay for your kids' college out of your home. You don't need to pay for your retirement out of your home. You need to pay for those things by investing in the way that I call you to do so in the financial action plan. So a house is primarily a place to live, and it is not an ATM. Now, the third lesson that we can learn from the Great Recession is that stock prices can keep falling for a very long time, okay? The painful fact of life is all too easily forgotten. In a bull market, the smart investor's mantra is buy on the dips. That is, buy when prices fall because they won't stay down long. In bear markets, they do, right? In bear markets, prices do stay down for a long period of time. So buying the dips becomes all the more real. Between October 2007 and March 2009, stocks plunged 57%, down a seemingly bottomless hole, right? The stock market fell for a year and a half. Okay, it did not have any type of legitimate correction for a year and a half. That is a long time to feel the pain, right? You're talking about a 57% plunge in a year and a half, right? If that were to occur today, I mean, people would go crazy. I mean, even the coronavirus crash happened very, very fast, right? Stocks dropped fast and they recovered fast, right? But during the Great Recession, it was just a constant drip and a constant dip of stock prices, lower and lower and lower and lower. 12 years of gains disappeared in 17 months. which is just absolutely outrageous. Now, you could say during the coronavirus crash, a lot of gains were erased very quickly, but they came back very quickly as well. The big challenge in such a market is resisting the overwhelming impulse to join the stampede for the exit. Right? History has repeatedly shown that sitting tight is the key to successful stock market investing. Okay, so I told you before, there's three things you can do when markets crash. You can either sell, right? You can just sit on your hands, or you can buy more. And that goes from worst to best option, because if you sell, right, you lock in your losses and you won't likely be a part of the upside, or at least all of the upside, and you'll miss out on gains. So we don't want to sell. If you hold and you just sit on your hands, that's fine, right? And you'll ride the roller coaster to the other side, and I'm perfectly fine with that. But if you're buying more, then you'll be able to make more returns on your money. And even though the market's low and you're feeling the pain, be fearful when others are greedy and greedy when others are fearful. And that's exactly what you should do. If you sell, as many people did in 2008, you lock in your losses. That's a disaster. And the older you are, the less time you have to rebuild your savings. A bear market is easier to endure if I know how much pain I'm willing to face. As a rule of thumb, assume that your stocks and stock funds can drop 50% overnight and stay down for a very long time. This is a very good exercise, right? Pretend that your stock funds fell 50%. How would you act? Or that your stocks fell 50%. How would you act? Right? If you can't stand to see your total savings fall by more than 25%, which last year we saw it fall by more than 25%, right? You should invest no more than 50% of your portfolio in stocks. I believe that wholeheartedly. And especially if you don't understand what you're investing in. I've talked about this all the time. Know what you own. Understand what you're investing in, and then invest. Do not invest until you understand. But understand this lesson: stock prices can keep falling for a long time. Be a net buyer. Do not be a seller when stock prices fall. Then the fourth lesson we can learn from the Great Recession is that you can't avoid risk by avoiding the stock market. Like everything else in life, investing involves trade-offs. With stocks, you lose money when the market falls, but thinking only about that risk is like looking only one way when you cross the street. Look the other way and you'll see that with bonds, you risk losing purchasing power to inflation, right? Because especially now, bonds have very, very low yields relative to history. Okay, the best solution is divide your money into the asset allocation that you want, right? You need stocks because you can grow your money to keep pace with the cost of living, right? A healthy 65-year-old man today can expect to live into his 80s, so you need to be able to continue to grow your money over time. But you will not be able to completely avoid risk. And if you do want to avoid risk, guess what? You're actually going to take on risk. There is risk to avoiding risk. Now, what do I mean? When you look at the risk of the stock market, and you say, okay, well, I don't want to be a part of the stock market or the bond market or the crypto market or any other market. I just want to put my money in savings. And you think that's no risk, right? Well, that's absolute risk, because what's guaranteed to happen if you put your money in a savings account is that your money is going to be devalued systematically over time. That money is going to become worth less and less and less over time. But if you put money in the stock market, historically, your money has become worth more and more and more over time, right? So just in trying to avoid risk, you're not going to be able to avoid all the risk. And a lot of people thought that coming out of the Great Recession, like, man, I'm just going to put all my money in cash and it's not worth it. It's not worth, investing. It really deterred a generation of investors. But if they would have just taken advantage of the early days of that long bull market that we just got to the end of in last year, and some people say we're still a part of that bull market and we haven't, begun a new one. But if you just take that, right, those early days, and you invested a lot in those early days, you would have made a lot of money. So you can't avoid risk by avoiding the stock market.